Welcome to this explainer. Look, if you earn a salary, run a business, or invest even a single rupee, you're going to want to listen closely because the rules for your wallet just completely changed. We're translating the brand new Income Tax Act 2025 into plain English. No jargon, no dense legal text, just the absolute essentials you need to navigate this massive overhaul.
Okay, so here's the reality. Every single Indian taxpayer is now governed by a completely new law that kicked in on April 1, 2026. And, shockingly, most people have absolutely no idea. We aren't just talking about minor budget tweaks here. The entire framework governing your hard-earned money has been completely replaced.
For literally 64 years, we've all been filing under the 1961 Act. It was basically a confusing bowl of spaghetti. Just exceptions added to exceptions. Well, the government finally scrapped that entire maze. Now, while the old Act had 298 sections, the new 2025 Act actually has 536. But hey, don't panic. More sections actually mean each one is shorter, clearer, and replaces those dense legal paragraphs with straightforward, easy-to-read tables.
All right, let's jump right into Section 1, One Simple Tax here. Say goodbye to confusing timelines. This first change alone is going to cure decades of headaches. Under the old 1961 Act, you had to juggle two entirely different years for the exact same income. You had the previous year when you earned the money and the assessment year when you actually filed. Thankfully, Section 3 of the new Act fixes this with one unified tax year. It's just like how a company announces its FY 2025-26 results. The tax department finally speaks the same language. You earn it in tax year 2025-26, and you file it in tax year 2025-26. The whole assessment year confusion is officially dead.
Moving on to Section 2, the new default regime. Action is now required.
Now here's where you really need to pay close attention, because this dictates exactly what happens if you do absolutely nothing. Under the old system, the new regime with the lower rates was just an option you could pick. Now, under Section 202 of the new Act, it is automatically your default. From April 2026 onward, unless you explicitly file to use the old regime, your employer and the government are going to automatically calculate your taxes under these new rules.
So since you're automatically being dropped into this new default system, you're probably wondering, okay, what's the math? Exactly how much of a cut is the government taking now?
Well, under Section 202, we now have 7 progressive tax slabs, and honestly, it's incredibly clean. Your first 4 lakhs, completely tax-free. The rate is totally nil. From 4 to 8 lakhs, it's just 5%. 8 to 12 is 10%. 12 to 16 is 15%, stepping up gradually until you hit a maximum of 30% for income above 24 lakhs. The absolute biggest immediate takeaway for your wallet here is that the starting tax-free limit has been massively bumped up to 4 lakhs.
Which brings us to Section 3, zero tax under 12 lakhs. This is the massive Section 156 subsection 2 relief. Before you start worrying about losing your old deductions in those new slabs, let's look at what is absolutely the game changer of the 2025 Act. It answers the one question everyone is asking right now. How much can you earn before you owe the government a single rupee?
If you are a salaried employee, I want you to memorize this exact number, 12.75 lakhs. If your gross salary is exactly 12 lakhs and $75,000 rupees, you can actually pay zero income tax. Literally nothing. This happens thanks to a massive rebate under Section 156, subsection 2. If your net total income does not exceed 12 lakhs, the government gives you a 100% rebate on your tax, up to $60,000 rupees. And when you combine that with a standard deduction, it works like absolute magic.
Let's actually see that math in action. So, if you have an 8 lakhs income, your tax is $20,000, but your rebate covers it entirely. Your final tax is 0. If your net income is exactly 12 lakhs, your tax is $80,000.
The rebate covers $60,000 of that, leaving $20,000. But wait, if you are salaried, you get a 75,000 rupee standard deduction right off the top. So a gross salary of 12.75 lakhs drops to exactly 12 lakhs net. Marginal relief kicks in, and your final tax zeroes out perfectly. It is brilliant.
All right, Section 4, 5 heads of income. Same structure, new section numbers. Before you can calculate your final bill, you still need to categorize your money. Even though the rules and section numbers have changed, Section 13 says your income still falls under one of 5 familiar buckets. Your regular paycheck? That goes into salaries. Renting out a flat? That's house property. Freelancing? Business. Mutual fund profits are capital gains, and your bank FD interest is other sources. You absolutely must know your bucket because each one allows totally different deductions. Which leads us to Section 5, trade-offs and loss deductions, what you lose and what you keep.
Look, the government isn't just handing out lower rates for free. There is a catch. To get the default regime's lower slabs and that massive 12 lakh zero tax rebate we just talked about, you have to sacrifice your long-standing deductions. You can no longer claim house rent allowance exemptions. Section 80C for your PPF and life insurance? Gone. Section 80D for health insurance? Gone. Even your home loan interest deduction for a self-occupied property is completely off the table.
But it's not all bad news. The government does cushion the blow by letting you keep a few really powerful benefits. For instance, the standard deduction has actually been bumped up from 50,000 to 75,000 rupees. Plus, you can still claim your employer's NPS contributions, family pension deductions, and the Agnivir corpus. For a lot of middle-income Indians, this streamlined approach actually leaves more take-home pay in your pocket, but you really have to do the math to be sure.
Let's wrap this up with Section 6, 3 actions to take now, your urgent checklist for FY 2026-27.
Because this law is already live, you cannot sit around waiting for filing season. You need to execute these 3 steps today. First, check your salary slip right now to confirm which regime your employer is actually using for TDS. Second, calculate your tax under the new default slabs versus the old regime with all your old ADC and HRA deductions and just pick the lowest one. Finally, log into the tax portal and check your Annual Information Statement, or AIS. The department tracks every FD, property sale, and mutual fund. If your filing doesn't match your AIS perfectly, you are definitely going to get a notice. So run your specific numbers to find your best path. This new law is simpler, clearer, and honestly a great opportunity to take control of your finances. But it does leave us with one critical question to think about. With a new default regime intentionally hiding traditional deductions and the government tracking every single transaction via your AIS, what hidden tax-saving opportunities might you be missing if you simply sit back and do nothing? It's time to take control of your tax year.